الله نمضي يا هنيئا لمن سبق ويا حظ قلب من تقى الله قد خفق تمر بنا.
Assalamu alaikum wa rahmatullahi wa barakatuh. Welcome to the Alternative Financier, a show dedicated to publicizing alternative and more ethical financing solutions. We engage industry practitioners and scholars to understand how the finance sector is transforming to become more ethical and conducive to societal needs. On this inaugural episode of the Alternative Financier, we're going to be discussing the US banking system, which, when we look at the facts, we can determine that this is a system which once discriminated against, however, now targets Black Americans and other indigenous populations. Now, specifically for this episode, we're going to focus in on one aspect of the banking system, or one product per se, where I think we can all get a grip of how it affects us on an everyday basis, and that's the housing market. And where banks touch the housing market most directly is through mortgages. In order to tackle this issue of mortgages in the banking system, we're going to first talk about how the banking system discriminated against Black Americans and other indigenous populations by blocking access to modern banking via tools such as redlining. Second, we're going to go over how once they were allowed access, they were targeted via predatory products, i.e. subprime mortgages. And finally, we're going to discuss an alternative finance system or a banking system that, if implemented or was implemented, or if even the values were practiced, would have prevented such atrocities. For those who may be listening at some point far in the future, or for whatever reason you're living under a rock and you don't understand the political and socioeconomic context of the current times, then it's important for you to understand that in this moment we are experiencing a global pandemic from the invisible soldier called coronavirus, or COVID-19. At this moment in the US, roughly 50% of people are unemployed. What this context highlights is that we're living in a time where people want change. And not only do people want change, but for whatever reason, whether they're bored, whether they have more time at home or more time to digest content, they're listening. Now, moving into the content at hand regarding how the U.S. banking system once discriminated against but now targets Black Americans and other indigenous people, it's important to understand mortgage lending and how the current state of mortgage lending was created. Going back to 1934, we can see that the Federal Housing Administration, or the FHA, was created. Essentially what that organization did is it insured mortgages. So in order for banks to lend, in order for the banks to feel comfortable from a risk perspective, those mortgages would need to be insured. So this organization is actually the organization that people refer to when they're speaking about redlining. The Federal Housing Administration in 1934 refused insuring certain mortgages based on what they perceived as risky neighborhoods. And what happened is a majority of these neighborhoods that they perceived as risky were neighborhoods where Black Americans were mainly living. What that did is stimulated a push towards what we now call urban housing projects, because Blacks were not able to take advantage of the wealth created from home equity by receiving loans to purchase these houses, which were in abundance. Because these loans were so abundant, what that did was shifted a demand for housing. And in light of that demand, a supply was created in the suburbs. So housing in the suburbs were more affordable then. When we look at the concept of redlining refers to the red lines that were on maps created by the Federal Housing Administration, which showed that the risk was too high, literally in their underwriting manual, because the Federal Housing Administration wrote a manual for underwriting for the banks to follow, or for the agencies to follow. They redlined specific neighborhoods which they deemed to be too risky. And in these neighborhoods were neighborhoods which were dominated by minority populations, mainly Black Americans. Eventually, this was deemed wrong, and in 1968, the Fair Housing Act was implemented. But by this time, housing was no longer affordable. Black Americans missed out on that chance to build their wealth once again. Moving to present day, many of those zones that were considered hazardous are still minority populated to this day. And 91% of those zones that were deemed best or quote unquote least risky in the 1930s remain to be the same neighborhoods to this day. So when we look, I'm living in Massachusetts right now in Boston. You think about the neighborhoods like Wellesley, Weston, Natick. Those were the neighborhoods that were deemed the best then, and today they still remain to be the best. However, what we see is when that risk factor changes in the present day, it's mainly because of gentrification. So the influx of foreign people, I mean white Americans, young professionals into our communities, our black communities, suddenly makes the neighborhood less risky and therefore more likely to receive mortgage lending. It is from those historical practices and many of the values that still remain to this day that the concept or claim that Black Americans bring down property values stems from, which is false in and of itself, because often we are willing to pay a higher price than our white counterparts for the same property, which when you look at how property values are determined through basically the values of the properties around them based on what people are willing to pay, if Black American pays more, then the property value around them would go up. Keeping in mind that this was one opportunity out of many for the people in America to build wealth before it was the Homestead Act, various other initiatives where people were given opportunities by the government through agencies, through tax credits, in order to invest in themselves, invest in their communities. This is yet another opportunity where blacks were blocked from access, except this time we were blocked from what we now know as the modern banking system, and more specifically, the modern mortgage lending system. Now, before we move into our next point of how Black Americans have been allowed access into the banking system, but are targeted via predatory products such as subprime mortgages and the likes, I think it's important to point that in that environment of redlining, there was a demand from blacks to buy housing. And I think one of the areas where, if you want to do your own research, you can look into redlining in Chicago. You can see that there was a demand, but since the solution wasn't solved in the white market, meaning in the legal banking system, this demand was supplied, outside of that system. And, these were structures that were predatory. Nonetheless, they included high interest rates, and structures were such that if a black person was to miss one payment, that property would then be the property of the person who lent them the money or were allowing them to live in that house. The Black American lost all of their money in the home that they were living in. That's historically how blacks became a bullseye for people to take advantage of. Fast forwarding to the present day era, I think it's important that we take a closer look at what was the financial crisis before our current financial crisis, which is referred to as the Great Financial Crisis, or the GFC for short. This was a financial crisis that took place because of defaults on home mortgages, which was then exacerbated by derivative instruments, which is, again, a topic for another time. I don't want to get too far in the weeds here. Derivative instruments which bet against mortgages. But how were these mortgage products used to target Black Americans and other indigenous populations? In order to understand that, we'd have to take a closer look at the subprime mortgage product. When you look at the mortgage lending services and products provided by banks, what you see is that they are split into two groups, one being prime and the other being subprime. Prime means that these are less risky loans, and subprime means that these are more risky loans. Therefore, they have a highest interest rate associated with them. And just to put things into perspective, if you were to look at the average house and the average loan, a subprime loan would translate into $150,000 more paid over the course of that mortgage. So that's $150,000 more money out of the lendee's pocket. Keep that in mind as we discuss more of these statistics and facts that prove that blacks were allowed access but targeted via predatory products. The National Bureau of Economic Research did a very thorough study which concluded that race and ethnicity matter substantially in regards to mortgage lending, and specifically the dispersion of subprime mortgages. In 2007, which is right before the GFC, or the Great Financial Crisis, 50% of blacks had subprime mortgages in comparison to their counterparts, which were 22%. The Center for Responsible Lending did a study which showed that those with a credit score of 660 or better, in that group, 21.4% of blacks had subprime mortgages versus 6.2% of whites. So this is credit score the same, all else equal. Blacks had a significantly higher percentage of subprime mortgages. Furthermore, in the National Bureau of Economics' research, they concluded that blacks were 105% more likely to have a high cost loan. 105% more likely. When we look deeper into those details, we find that even within the black population, the black women were the most affected, with them 2.5 times more likely to have been given a subprime mortgage. And some people say that, well, that's because they have lower income, they're higher risk. However, that disparity only increased with income. The higher they went up the income stack, it showed that black women were 5 times more likely to have been given a subprime mortgage. The extent of these predatory tactics were confirmed by the city of Baltimore's filed lawsuit against Wells Fargo for practicing predatory tactics that targeted black American communities. Looking at the reports, you can even see how this targeting of black Americans became a culture within the organization. So much so that in Wells Fargo, it was reported that they would refer to these subprime mortgages as ghetto loans. The fact that the internal culture can get to a point in which these products were referred to as ghetto loans, I mean, it says a lot about the ethics in these institutions, and it sums up what the product was, designed to be. Even if it wasn't designed to be that, what these products became because of the cultures that dominate the US banking system and in general the financial system that drives the world, coupled not only with the high interest rates that these loans maintained. There were also various other levers that could be pulled to increase the profits of the banks, but were predatory against these black Americans who often this was their first time engaging with the banking system. Ballooning interest rates. For example, if you were to buy a home, your interest rate, picking a number out of thin air here, it may have started at 3%, which was affordable for you. But if this event occurred, or when this amount of time passes, it would increase to 6%. This is just a number I'm using for exemplary purposes. People went into these loans oftentimes because they thought, okay, I would have that income by that time, or they were looking to do a quick flip, so they were planning to participate in appreciation of their properties. However, these loans, these subprime mortgages were being created. They were being mass produced. And one of the drivers for the production of these loans, it wasn't to be good people. It wasn't to help blacks attain housing. The banks were looking to make money. And there was a product called CDOs, which stands for collateral debt obligations. I'm not going to try to explain what it is because even in high finance and private equity, which is where I work, it's hard to even explain to seniors what exactly this product is. That's how intricate it is. In short, these subprime mortgages needed to be issued in order to feed into the machine that was pushing out these CDOs for corporations to buy, for banks to buy, for private investors to buy, in order to profit on these pools of loans which generated a cash flow for them. We all know what happened. If you don't know what happened, the creation of these CDOs and the collapse of the housing market, it was the domino effect that occurs because of the CDOs dependence on the housing market or its derivation from the housing market, which exacerbated the effects of the Great Financial Crisis, or the GFC. If you're looking to learn more about those CDOs and how that contributed to the GFC, or the Great Financial Crisis, you can watch the movie The Big Short, which goes into much more detail and how these products were created and how people made money. And yes, there's people who made a lot of money off of the housing crisis. Back to the topic at hand of Black Americans being targeted through predatory practices. The Urban Institute found that after the Great Financial Crisis, for blacks, wealth decreased 47.6% compared to our counterparts, which only decreased 28.5%. Much of this can be contributed to foreclosures, which, when you look at subprime mortgages, they are foreclosed on more because they're more expensive. And when you look at the effects of a foreclosure or the failing of a mortgage, it typically affects more than just the loss of housing, because especially for those who are not very in tune with financial education and understand how the banking system works, these people were trying to save their house, save for many what was their only asset. They drained their bank accounts to keep up with payments. They asked people for help to help them to pay their mortgages until they couldn't anymore, and their house was foreclosed on and they lost everything and their savings was drained. Now, someone who is educated and they see that the value of their homes is lower than the remaining payments on their mortgage, they will try to negotiate, or they would just bow out and say, well, I'm just going to move on from this one and save my remaining assets. We didn't know that. And that leads me to another perspective here, because many would say that, well, it's their fault for taking a subprime mortgage. They should have, shopped. They should have compared different packages, different loan packages. Yes, that is true. There is some blame to be put on, our community for not educating themselves. But we have to keep in mind that there's two sides to that coin. Even then, there have been studies which have shown that lenders give more educational information, spend more time getting white borrowers up to speed. We're not saying that this is something that they directly choose to do, but we're showing that these are the facts. Field studies have shown it, whether it's due to unconscious bias, whether it's purposeful. This happens. In conclusion, these predatory practices that US banks and perhaps banks globally have been implementing have placed a greater financial burden on Black Americans, which has slowed the accumulation of wealth. And some of the direct effects of these predatory tactics, for those who were foreclosed on or they were behind on payments, their credit scores were hurt, impacting their ability to access the credit markets into the future. And for those who lost their homes, this meant that there's less Black American home ownership. And that point is very important to digest, because home ownership is something that's integral to our system. Property taxes is something that affects many community services such as police, emergency services, infrastructure investment in your specific community. So when blacks don't own their homes in their own communities, it's harder for them to have a voice and really to care as much about the community that they live in, because they don't own it. It doesn't feel like their community. In the world of private investing, this is what we refer to as the concept of aligned interests. Just to give you an example of that, if my firm is looking to invest in a new private equity fund, we find comfort in knowing that the managers of that fund also have a sizable piece of ownership in that fund. It means that they have a vested interest that is aligned with ours, tying that back to the concept of home ownership in Black communities. If Black Americans are given the fair shot to actually own the properties in their community, then they will have a vested interest in improving their communities more so than we have in the past. Right now, it feels like any efforts we put forward is at the benefit of someone else. the benefit of the people who own it, who are often aren't from our communities, don't live in our communities, and to be quite frank, they don't care about our communities. Now that we've discussed both how the U.S. banking system has blocked Black Americans from participating and now targets Black Americans through predatory tactics, through products such as subprime mortgages, we can now move forward to some possible solutions to the current system. For those of you who do not already know, I'm a Black American Muslim. So what that means for me is that Islam, it's like a filter that everything in my life, culture, my job, my family relations, filters through that filter, and on the other side, it still remains what it was before, but cleaner. So in Islam, we have a solution to the atrocities in which we have spoken about. This is referred to as Islamic finance, which, is one term, but I like to refer to it as alternative finance. And in this alternative financial system, there are two solutions. One is a technical solution, and then the second one is an ethical solution. So beginning with the technical side of things, there is no allowance of excessive uncertainty. So when we think of these products such as CDOs, which created the demand for these subprime mortgages to be created, or credit default swaps, which were the derivative instrument that was created to bet against the housing market. When I say bet against the housing market, it means you wish that the housing market would crash so that you can make money. These types of instruments will be done away with. And it does away with most other complex derivatives that create imbalance in our banking systems. Furthermore, there is the concept of risk sharing, which is required on any permissible transaction. Risk sharing means is that the financial institution shares in the success and failures of the underlying asset or the business endeavor. In the case of housing, what that would mean is if the underlying value of the house decreased, then the bank would also be sharing in that loss of the equity value of that house. In the case of businesses, what that means is if the business loses money, then the financial institution will make less money as well. In the current system, the bank or the financial institution makes the same amount of money regardless of the success or failure of that business. And that's fair on both sides. The institution should make more money if the business is more successful, and they should make less money if the business endeavor is less successful. And what that does is it aligns the interest between the institution and the lendee, which would mean that the bank would not be inclined to lend to situations which are not ideal. It would require them putting more fiduciary efforts into their lending. And finally, one that is probably the most talked about is Islamic finance does not allow the usury, or riba in Arabic. It's like interest, but it's making money on top of money. So money that you're not due, excessive fees, excessive profits that you did not earn per se. But for those who are not concerned with riba, let's talk about some of the ethical aspects which can benefit everyone. And let's start with no predatory tactics are allowed in Islamic finance. And we look at the subprime mortgage crisis, the use of low introductory rates and then switching them later. This is something that's not allowed. From a technical perspective, once the price is set, the price is set. And then from an ethical perspective, it's just not right. Another predatory tactic of feeding the CDO machine through the issuance of subprime mortgages. This would not be allowed. Secondly, in times of financial distress, much as we see today in this COVID-19 environment during this global pandemic, forbearance is encouraged. Institutions are encouraged to show forbearance when someone faces a financial difficulty. Third, no additional fees are allowed to be contributed towards profits. In the current banking system, banks make a ton of money on additional fees that occur if you miss a payment. If for whatever reason X happens, then you get this additional fee that wouldn't have otherwise occurred. This is not allowed. In a sense, it's not allowed to go towards the profits of the bank. It's allowed if those extra fees are going to go to a charity. And in that case, that would mean that the fees are only there to encourage the lendee to hold to their promise. It's not a tactic in order to extract extra profits out of the customer. And then fourth, losses on loans will be counted as donations, or for Muslims we call it zakat, which is one of the pillars of Islam. What that does is it encourages banks to not try to always figure out how to weasel profits out of their customers, but instead work with them. And in the case that the bank takes that loss, it can be counted as a donation or as a zakat payment for the owners of that institution. It's very important as we think about alternative solutions to our current system that we look at it from both technical perspectives, such as practices that we would not want, these derivative instruments, excessive interest, structures where people really don't participate in the risk of the underlying asset or the success of those businesses. And that we look at it from an ethical perspective, where forbearance is encouraged. There's no additional fees that you can make a profit from. No predatory tactics allowed. And that in having these ethical and technical standards in this new system, that there is more oversight on the review and compliance of these features. Wrapping things up here, it's important that we take a step back and look at the position of Black Americans in this society. And Black Americans is an all-encompassing term, which for me, I use it to refer to those people who are descendants of slaves in the US. So that can include African Americans, Caribbean Americans, and many of the Afro-Latinx communities. We are the indigenous populations of this region, and as we take an honest look at how we're viewed in this society, we're viewed as the descendants of slaves. It doesn't take us to go back but to the 1800s, for some in the South, maybe even the early 1900s. What that means is that the economy has been on our backs, and it has remained on our backs. That reason is why it's very important that we work towards developing our own institutions. That includes medical institutions, educational institutions, social institutions. And what supports the creation of those institutions is the creation of our own financial institutions, which is the lifeblood of our operations. In order to push forward, we need capital. When we develop our own institutions, that means we have control of the business operations from the top down. And what that means is that we have oversight on the creation and issuance of the products and services that our communities need most. We have control over who receives funding and who doesn't receive funding. And what that means is that it's no longer in someone else's hand outside of our communities on which projects move forward, on who gets to own a house, on which neighborhood is valued more, on who gets to start a business. Developing our own financial institutions gives our communities the power to both organize and execute our own solutions for economic prosperity without the influence of those whose interests are misaligned.